The S&P 500 finished up nicely today, but it kind of felt like a faux rally once again. In other words, we had a handful of companies that really outperformed, and they just happened to be those mega cap tech stocks, the Magnificent Seven. 6 out of those 7 had very nice days today. But what we actually saw were about 2/3 of the S&P 500 closing in the red today, despite the green activity of the index at large. So we're going to have a nice conversation about that in tonight's video. We're going to look at all 11 sectors from a market cap perspective to get a true sense as to how important some sectors are versus others when we look at the traditional market cap weighting approach of the S&P 500. We'll see how all of that affects our postures from the various indices perspective. We actually had 2 different indices that went back to a weekly bearish posture here today. We'll take a look at what happened with interest rates and also with the US dollar and how that impacted a number of other macro charts here today. And then we'll get into our trade application example where I wanted to feature a short sale on a very popular consumer stock that ended up having a little bit of a bounce at the end of the day. Nonetheless, we'll see the trade through. With that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 22nd, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then come down into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. At the bottom of the emails, you'll also find which stocks are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that click like and retweet on these Market Outlook posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see from our S&P 500 heat map, we actually had a lot more red squares on the board than green squares. So today was another one of those strange days where when you glance at the Wall Street Journal in the morning, you'll see that the S&P 500 was up nicely today, about 0.37%. Yet when you look under the hood, you'll realize that there were way more stocks down than up. And the reason that can happen is because the S&P 500 is a market cap weighted index, and therefore the biggest companies have more weighting within the index. And therefore, if you have a random day where the biggest companies are up, but the vast majority of small companies are down, you'll likely find that the S&P 500 was up on that day. And today was one of those days. Let's get into it. First one that stands out to me is Amazon, which basically tied with Palo Alto Networks as the best performing stock in the market today. Had a chuckle about that a little bit because it was either yesterday or the day before there was supposedly bad news about Amazon and how they were being sued by Justice Department or someone about how they were making it difficult for people to cancel their Prime subscriptions, which I had never heard of that before. So a lot of times you kind of get a sense of which companies are kind of in the wrong with their corporate policies and practices and things like that. But I had never heard anybody mention that before. Now, obviously, not everybody is a Prime subscriber. I am. I rarely watch any of the videos that they offer me there. My wife, I think, listens to the Amazon Music quite often, but we do shop on Amazon a lot. It seems like we've got a Amazon delivery truck out front. So I have on most days, but I have no idea, at what point I would consider canceling my Amazon Prime subscription. But I guess for those that have considered that in the past, it's been a little bit more challenging than they would prefer. So it was a little amusing that just the other day, Amazon was one of the worst performers in the market upon that news, and today literally tied for the first best performer in the market. And so that $1 trillion plus company got a little bit stronger here today with a 4+% move to the upside. Now, they weren't alone. As you can see, Apple had a great day. In fact, I'm pretty sure Apple hit an all-time high today, if I heard that right, on CNBC. Thursdays are a little bit busier for me since it's when I teach a longer class with my Q&A class earlier in the day, so I don't always get a chance to follow the news beat by beat. But I think I did hear someone along the way say that Apple hit an all-time high today. And of course, Apple is the world's largest publicly traded company. So that's going to help the S&P 500 tremendously when they outperform in a big way. Excuse me. And they did. They were up 1.65% today. So that's a nice move on a $2.9 trillion company. Microsoft was barely outdone from that regard. They are a $2.5 trillion company, and they were up 1.84% today. And then Alphabet, also a very strong showing today, up 2.16%. Meta was up over 1%, so there you can see, another strong performance above average for the market in general. And then Tesla also nearly a 2% move today. So with this whole hoopla around what they refer to as the Magnificent Seven, I just rattled off 6 of them that were easily outperforming the market today, and some of them with really strong moves like Amazon. The only one of those 7 that didn't really amount to much today was Nvidia. Kind of cooled off there, took a breather today. Still trading at $430, still a $1 trillion company, but was basically break even here today. So it didn't really add or subtract anything from the overall markets here today. But 6 out of those 7 were big winners today, and that's why we see a day like today where you only had about a third of the stocks in the green, yet you had the S&P 500 up easily today by 0.37%. In terms of other bigger movers, FedEx had a strong rebound. Remember, they had just reported their earnings here earlier in the week, and initially the market didn't really seem to appreciate their earnings, but they came firing back nicely here today. You also saw that Dollar General was up 3% today. 1 week ago, I got asked about Dollar General in my Q&A class and gave it somewhat rosy analysis in terms of what I tend to look for in longer-term investments moving forward. And it has had a very nice response since then. Of course, I had nothing to do with that other than just didn't want to give up on that company. We've never bought it in my classes. It was one that I had mentioned that was on my shopping list for our DGI class, but it didn't quite hit the our rules that we have for that class on the Tuesday morning when we were teaching the class. So it's one that we might just have to let get away from us and let others enjoy. But it's been nice to see that one responding here more positively over the last week after it had been nosediving up until that point. We also saw some strong performance out of the healthcare stocks here today. Notice that Merck was up 2%, Abbott up nearly 2%, Eli Lilly up 1%, Johnson & Johnson up 1%, United Healthcare was up again. Remember, I still have that iron condor going on United Healthcare. I do have a trip scheduled where I'll be away for a few days next week, so it's possible I shut down that United Healthcare Iron Condor before I leave, so keep your eyes on our Telegram channel if you're a premium member, if you want to be following along with any sort of management decisions I'm making along the way. But it's nice to see it kind of get back into the middle range of the Iron Condor after it was testing it in a big way to the downside just about a week or so ago. We also saw that HCA was up 2.5% today, and there's a lot of other healthcare companies that managed to end in the green today. So I imagine healthcare was probably one of the better performers. One of the worst performers, let's now take a look at the negative side of the equation. One of the things that caught my eye today was how poorly the banks traded. Remember, that's been one of the keys of the market here recently. And you'll notice the banks were really out of favor today. JP Morgan down 2%, Bank of America also down 2%, US Bank down 3.5%, M&T down nearly 4%, Regions down 3%. A lot of those regional banks, once again, started to suffer from some selling. And of course, that was a little reminiscent of what we had to put up with back in March and April of this year. Things have calmed down there. Unfortunately, we just had those 3 bank bankruptcies or government takeovers, or however you want to say that, and we haven't seen any additional ones kind of be in the market's spotlight since then. But it doesn't mean that we're done with it either. And today is a friendly reminder that risk is still present. So financials did not perform particularly well here today. Another area that seemed to be out of favor was energy. Notice the energy area from a sector perspective was nearly all in red today. We had, I think, just one green performer, and that was Hess, and it was only up 0.43%. But there were some pretty big movers to the downside, including EOG, down over 2%, Conoco down over 2%, Phillips 66 down over 2%, So those are some of the bigger names there. And again, not a very pleasant day there for energy. Remember when I was with you on Tuesday, energy had joined the utilities as being the only two sectors at that time that were with a bearish market forecast posture. And it doesn't look like they helped themselves out in that regard here since then. Notice that utilities were mostly down today as well. We had one right there, energy. That's always fun to say over and over again. So there, as you can see when I hover my mouse over that square, their name is the letters NRG, and then immediately followed with energy, so energy, and their ticker symbol happens to be NRG. Anyway, it was one of the rare outperformers in the utility space today, up 3%. Pretty much everything else closed in the red there. So seems like financials, energy, utilities, even the retail or the real estate investment trusts were out of favor today. Seemed like where we saw our success was probably around technology, communications, maybe a bit of consumer discretionary, and then healthcare. By the way, I posted a kind of an interesting graphic. I think it was from Visual Capitalist here earlier. For those of you that follow my Twitter stream, you might find it interesting, at least I did. By the way, just heard some news about 3M settling some lawsuits. Now remember, before you get too excited about that, with the stock up 4 or 5% after hours, they've got a lot more lawsuits to settle. So we've seen what seemed to be pretty good news out of that in the past, and it's really led to not a whole lot, but getting a little bit of a pop after hours there for 3M. But I wanted to show you, this was kind of a cool video as well. If you wanted to get a sense of how deep the Titanic crash was, of course, condolences to the families of those 5 members on that submarine that they found here earlier today. But that was a pretty cool video if you want to check that out as well. But here's what I was referencing. This graph right here, the entire S&P 500 and how it looks from a sector perspective based upon market caps. And as I was mentioning up here, the technology sector alone is more important than 5 entire sectors combined, which includes the consumer staples, energy, materials, utilities, and real estate. So, that's another way to kind of think about it. What I just mentioned here a moment ago when we were looking at the heat map is looking at it on a stock-by-stock basis and looking at stocks like Amazon and Apple and what have you. But another way to kind of think about that market cap breakdown is on a day when you have the technology sector up, you could theoretically have energy, utilities, real estate, materials, and consumer staples all down on that day, yet it wouldn't matter at all if technology was up, at least up enough. So that is how influential these big mega cap tech-oriented companies are, and the sector itself is here these days. Anyway, let's go ahead and pop on over here and take a look at the specific breadth numbers now. And you can see that I've got the S&P 500 pulled up in our Market Watch Visualize area. 178 stocks closed higher today. Yes, you're reading that correctly. The market was up nicely today, yet only 178 companies in the S&P 500 were up. So that was only about, I guess it was 35%, somewhere in that general vicinity. So about a third of the companies were in the green today. 2/3 of the companies were in the red, yet the market itself was up very nicely, thanks to Apple and Amazon and Tesla and some of those types of companies. All right, let's take a look over here now at our foregrid and see how, if at all, the postures have changed using the market forecast technical indicator. Had a question about this to a degree here in my question and answer session earlier today. And just a friendly reminder, if you hear me say things like, the S&P 500 is bullish or the Russell 2000 is bearish, remember, I'm just reading the rules of the market forecast technical indicator. So that's not necessarily like my opinion or anything along those lines. I know sometimes that can be maybe a little bit confusing to especially newer people to the markets. Those of you that have been with David and I long enough know that by now. But what we're doing is we're trying to judge what the posture is from an intermediate time period, and we're using one technical indicator to do that. And that technical indicator is the market forecast. You can find the market forecast on the Thinkorswim platform. By the way, I did get on a couple of my TD Ameritrade accounts a notice that my transfer of my assets is going to go through over Labor Day weekend. So I've got a few months here. Some of you have probably already gone through that, but I do hope that after Labor Day, I will still be able to access my Thinkorswim platforms and be able to get into my charts and all that kind of stuff. So stay tuned on that, but just thought I would point that out because some of you might have received that notice in your email inbox here recently as well. Anyway, the market forecast is something that is unique and proprietary to Thinkorswim and really TD Ameritrade, which will eventually be Schwab. But anyway, we used to use it at Invest Tools, which was the education arm of TD Ameritrade, where both David and I worked. And so we've continued to follow it even since we've separated from them and started our own business here. And it's not perfect. Remember, no technical indicator is. There are literally over 200 technical indicators out there, so it's not necessarily that one is superior to the other. They all have their pros and cons that you have to think about. But in general, it does do a reasonably good job of putting us on the right side of the ball when it comes to judging posture from an intermediate perspective. So when you look at these background colors of the charts, that will tell you what the current posture is using that green intermediate line. So, intermediate you can kind of think of, or at least the way I think of it in my head, an intermediate period of time is months. The near-term line kind of helps the swing traders, so that's in terms of weeks. And then the momentum line, the red one, is really day-to-day. So it's really short-term. I guess if you're a day trader, maybe you could use that. But what most of us care about is kind of month-to-month philosophy. We're not active day traders in and out multiple times per day with most of our strategies that we teach here at Market Scholars. So our approach tends to lean towards that green line, which is known as the intermediate line. And when that green line is rising between 20 and 80, we do consider that bullish. If it's below 50th percentile, we would call it weakly bullish. If it's above the 50th percentile, we would call it strongly bullish. And then if it's in the upper reversal zone at all, in other words, somewhere between 80 and 100, it doesn't really matter if the line is going up or down, as long as it's above 80, we also consider that strongly bullish. And that's where we find ourselves with two out of these charts right now. However, the other two just saw a change in that regard. So let's talk about the two that did not change here first. And those are the two that did the best here today, which makes sense, right? These lines are basically reacting to price activity, right? They're not trying to predict the future based upon something that has nothing to do with price. They're basically evaluating the past price and projecting the future. Knowingly, there will be plenty of times where there will be, some things that don't work out the way that you want. Again, no technical indicator is perfect, but in general, it's done a pretty good job. So the S&P 500 up at the top, upper left, was up 0.37% today. You can see it does break that 3-day pullback that we had previously. Also note that the last 2 days we had those bullish intermediate confirmation signals. So some of you might have been buying that. Hard to say. As I mentioned on Tuesday, it's hard to get too excited about it just because there wasn't a huge dip that you could have bought. Yes, there was a dip, but it wasn't particularly large and massive and looking for immense undervalue opportunity or anything like that. But there was a bit of a dip. And so some of you might have bought that based upon that signal. Today, we had a fairly good reaction to it. Today's candle you would identify as a bullish engulfing candle, where today's body engulfed yesterday's body, and that's usually a good sign. It does tend to lead to reversals back the opposite direction quite often, and so that's the hope of the bulls right now. You'll notice that the green line, the intermediate line on the market forecast technical indicator, remains in that upper reversal zone that I had mentioned before, somewhere between 80 and 100. And remember, these labels that you see underneath each of the charts are going to tell you what today's current number is, or reading of that particular line is. So today's reading of the intermediate line was at 85 and falling. Now, falling doesn't sound too good if you want to be bullish, but there's a reason for that. We give it some, wiggle room, a grace period of sorts up there, and it is, allows for a 3-day pullback like we just saw right here before saying that, oh, the markets are really bearish now all of a sudden, right? That would be kind of a little bit foolish. It seems like, there hasn't been that big of a sell-off there. So it just provides a little bit of flexibility up there at the top. Now, if it does fall below the 80th percentile, then that background color of the chart will change. And that could happen tomorrow, right? If we have a big down day to end the week tomorrow, it is possible that we would see that happen on the S&P 500. Personally, I'd be pretty shocked if it happened on the NASDAQ. There's enough of a little air gap there where it would have to take a really, really aggressive down day for that to happen on the NASDAQ, but it's a little bit more realistic that the possibility is there on the S&P 500. Nonetheless, at least for today, they kind of collected themselves, and there was a little bit more resilience from the bulls here today after taking the first few days of the week off. So we do remain with the strongly bullish posture, and you'll notice from the background color it helps your eyes judge how often we've been bullish or bearish using that technique. And on the S&P 500 over the last 3 months, you can see that the background color has been green way more often than it's been pink. There's only been a few times in between for a few days here and there where it went to pink. Otherwise, this has been pretty much a green chart the entire time. And if you look down on the NASDAQ here, down below it, it's even more dramatic. I mean, there's really only 3 areas where there was pink the entire 3 months. You had one day right there at the end of March. You had one day right there at the end of April, and you had 2 days there at the beginning of May. Other than that, all the rest of the days in the last 3 months have been considered strongly bullish postures according to that intermediate line that we use on the market forecast technical indicator. So especially for the NASDAQ, I would say that the market forecast has done a bang-up job. It doesn't always work that way, and we'll talk about the Russell 2000 here in just a moment where it hasn't been quite as easy. But at least with the NASDAQ, that's been a really nice way to keep you on the right side of the trade. So as you can see, the NASDAQ was today's leader. Again, no surprise there with those magnificent 7 that I had mentioned before. 6 out of those 7 having big outperforming up days today. All of those 6 companies belong to the NASDAQ composite and are going to assist it on a percentage basis much more so than these other indexes out there. So both the NASDAQ and the S&P 500 have a healthy dose of market capitalization weighted tech heavy attractiveness to them here at the moment. So on days like this, they're going to get that benefit. The Dow Jones and the Russell 2000 don't get that benefit, right? If you think about a stock like Amazon, it has 0 impact on the Dow Jones Industrial Average. It has 0 impact on the Russell 2000. It is not part of those indices at all, and it was the most important stock probably in the entire S&P 500 today, and probably the NASDAQ composite as well, because it was up over 4%, and it continues to climb a bit after hours. So both the S&P 500 and the NASDAQ composite continue to retain their strongly bullish market forecast posture. Both of them have rising 30-day moving averages that their price is above, which is why those moving averages themselves continue to be colored green. And by the way, that is the case with the Dow Jones and the Russell 2000 as well in terms of the color of the moving average. Price is still above rising moving averages, which is more of a bullish feature. However, there is now some differences in the posture according to the market forecast technical indicator. Notice that both the Dow and the Russell 2000 now have a pink background color. And for both of them, it's been, 3 weeks or so since we've seen that. So there's been enough of a give back off of the highs here recently where it has affected that technical indicator a little bit more aggressively than what we saw with these other two. And I think one of the big reasons is you'll notice that both the Dow and the Russell 2000 were down today. Dow just barely, 0.01%, but the Russell 2000 was down 0.8%, and that was likely due to what I had mentioned before on the heat map. All of those banks got hit hard today. And remember, there's a lot more direct banking exposure in the Russell 2000 than there is in these large cap indices that are out there. I think it's about 1/10 of the Russell 2000 makeup is in those mid-cap and smaller banks. So on a day when banks do poorly, it's usually going to hit the Russell 2000 much more so than the others. So no surprise that the 2 of these 4 indices that were down today were the 2 that saw their postures switch from bullish to bearish there as well. Had the S&P 500 closed lower today, it's entirely possible it would have joined those other 2. But since it closed up nicely, it avoided that fate for now. And again, it could happen as soon as tomorrow. So don't bank on an epic reversal here or anything like that. But at least there's that chance. Anyway, the Dow Jones now goes to a weekly bearish posture. The Russell 2000 also goes to a weekly bearish posture. Notice the phrasing there. It's not strongly bearish. That would occur if this green line doesn't just drop down below 80 like it's done here. It's down at 78 right now and falling. If it drops below the 50th percentile on this indicator, then we would consider that strongly bearish, and the background color will turn to that darker shade of pink like we see back here, as opposed to this lighter shading that we see over here. So right now we're just in the lighter shading, but if this green line does come down below the 50th percentile, what's likely going to happen in order for that to occur is the price action up here is probably going to have to breach that moving average. That would be another sign that, yeah, the bears are more committed this time around. Right now, I think there's still reasonable hope that this could be just a very temporary bearish posture here for the moment. And the reason I say that is, generally speaking, unless I have reason to believe otherwise, I'm going to assume that the path of least resistance for a security is whatever direction its 30-day moving average is heading. And right now we do have the support of those rising 30-day moving averages there on both the Dow Jones and the Russell 2000, that despite their weekly bearish postures according to the market forecast, could still result in reasonable bullish upside if the cards shake out the right way. So I don't know how much I'm going to read into that right now. It's worth at least noting and observing. But I'll remind you that, for instance, back here, on the S&P 500 back in the first week of May, we also had a 4-day pullback, or a 3 or 4 day pullback there. And notice how we went to a bearish posture there, but the very next day we were back above that moving average. And so on a day like that, I would ask myself, what are the chances that we can make a big move higher? And I would say the chances are reasonable because we remain above the rising moving average. It's the same thing right now. So I don't think this is like a heavy sell signal or anything like that. It's at least noteworthy. The way I kind of think about it is, if you've got a storm coming through, you're oftentimes going to have storm clouds that appear first. And for those of you that deal with storms regularly, you'll know that not all clouds lead to storms. Some of them do, so it's rare to find a storm that didn't start with clouds. But we also know that clouds show up regularly and then don't amount to any sort of major storm. They just kind of blow out of the system and you got sunshine. So right now I kind of think of the weekly bearish light pink background color as the clouds are in the sky. We don't yet know whether an actual storm is on the horizon. We will await further information from the market itself. So anyway, Dow was basically flat today, but didn't stop it from going to a weekly bearish posture. Russell 2000 was a little bit more aggressive, and I think that's as a result of their banking impact. And you can see it's the 4th day in a row to the downside for both of them. But that Russell 2000 was a more aggressive day, down 0.8%. It's a pretty sizable day. But again, above the rising moving average, so I don't want to make too much of it quite yet. If it starts breaching the moving average, then we can talk. Until then, let's make the assumption that there is interest in buying stocks in 2023. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. And last time around, you guys did not disappoint at all. 114 of you clicked like for me, which I certainly appreciate. Remember, that's our way to kind of quote unquote advertise our business, as we don't have a advertising budget that you'll see a commercial of ours on CNBC or something like that. So our way to advertise is effectively through word of mouth and for you guys using the social networks and all that kind of stuff. So thank you to the 114 of you that clicked like for me the last time around. As I always say, as long as we're up and over 100 likes, more than happy to give you a full-length presentation, typically closer to an hour, and include the bells and whistles like the sector selectors and the factor selectors and the 12 grids and the trade application examples and all that kind of stuff. On the other hand, if you don't like these hour-long videos, and remember, it's impossible to please everybody, so I know there's plenty of debate back and forth in your mind as to what we should be doing, but what we will do is, of course, what we think is in our own best interest and hopefully helping you guys along the way at the same time. So if you don't like these longer form videos, no problem there at all. I'm more than happy to save my own time in doing them. So what you would want to do is not click like. And if we don't get to 100 likes, then that would be a time time where I would just keep it nice and short and sweet, only 15 minutes and only focusing on the 4 indices themselves. So again, thank you to the 114 of you that did that for me last time around. Let's do some shout outs. Thank you to Leah, thank you to Jim, thank you to Trader, and to Angie, and to Michelle, and Teresa, and William, and Biomedical RX, and Pam, and Richie, and Barry, and Rich, and David, and Dividend Cactus, and Dennis, and Paul, and Irene, and Easy, and Floyd, and Judy, and Trunk, and Sherry, and Michael, Common Sense Investing, Maria, Vernon, Christopher, Roger, Greg, El Zulu, Cynthia, Wayne, Keolia. I can't get to all of you, but I do appreciate all of you nonetheless. So thank you very much. Please keep that up, and we'll do our best to continue to fulfill with some good education for you guys for free on YouTube as we go forward. All right, let's also have a little bit of a chat here about our Factor Selector tool. A reminder that this gets updated on Tuesdays, so it's a little bit stale here at the moment, but not tremendously so. And we haven't really seen much in the way of major movements on this anyway, so I don't really think there would have been any difference had I done it today versus Tuesday. Nonetheless, we use this for my Wednesday morning factor-based swing trading class. And if you're a premium member, of course, you have immediate access to it. Anyway, let's see what we can learn here. For the 5th straight week, we do have quality leading the way. And once again, it is following the same pattern that we've identified plenty of times for you in the past, which is quality effectively is tracking the technology sector right now. If the technology sector is doing well on the sector selector, there is a very, very high likelihood that quality is doing well on the factor selector. And that has once again proven to be the case with technology number 1 and the quality number 1 on the respective selectors that we use for my classes. Number 2 is low size, but that's one I think is a little bit more questionable here all of a sudden after today. It would not surprise me knowing what I know right now. Now, again, there's plenty of time between now and Tuesday where things can change, but knowing what I know right now on a Thursday afternoon, this strikes me as a possibility that low size next week could go down to the number 3 position and be replaced by momentum at number 2. And the reason I say that is because the banks did so poorly today, and we also saw the Russell 2000 do poorly versus the other large cap indices, that it just strikes me that this is a moment where there was some legitimate slippage in small cap companies here today, and it wouldn't be entirely surprising to see that show up in the rankings. Now remember, these rankings are driven by the WAR score. And the WAR score is an acronym. It stands for Weighted Aggregate Returns, where we're taking the performance return information from 3 different time periods, 1 month, 3 months, 6 months. We're aggregating them together, and we're weighting the 1 month more heavily than the 6 months. So it spits out a ranking system for us. And so it's not a guarantee that just because of one day that the Russell 2000 did poorly that you have to see deterioration in the low size category. But because it was a fairly big underperformance day, in other words, the large cap indices were largely up today on a day when the Russell 2000 was down 0.8%. That's a pretty major difference between those two areas. I'm going to get the sense that there's a possibility here that low size may drop next week for the first time in a month, right? They've held that number 2 position for 3 weeks in a row, but that may be about the end of it if today was any indication. Momentum made a move higher. I'm not particularly surprised by that. We've done pretty well in my top-down trend trading class here recently on the backs of stocks like Apple and Nvidia and Microsoft and Alphabet. Yes, we do own all of those in that particular class. And so since those mega cap tech themed types of companies have been doing pretty well, I think the momentum trend trading philosophy is holding in there pretty well at the moment as well. Remember, that was not the case last year. So we're happy to be back in the good graces of the market gods. But, we had some challenging moments last year, without a doubt. This year has been much more kind to trend traders. Value did slip. And again, there's a pretty healthy overlap in value as well with financials and also energy sector. So both financials and energy seemingly did poorly today. That has the potential of dropping value even further next week. So wouldn't be surprised if momentum moves up to number 2, low size moves down to number 3. Value could very well end up dropping down to number 5. We'll have to see. Low volatility was remaining in the number 5 position this week. Remember, there's quite a bit of interest rate sensitivity associated with the low volatility factor, and with interest rates holding up at reasonably high levels here recently, it's not a surprise that those types of businesses, utilities and what have you, were out of favor here recently. And then that's kind of the same story with dividend yield, right? They've been major laggards, I'm sad to say, as I own a lot of dividend stocks myself, but it is what it is, right? We know these things go through cycles. Right now is one of those moments where dividend stocks are not in favor compared to the really exciting, bright, shiny objects known as the AI stocks out there, right? Who needs I don't know, Coca-Cola or something like that, if you've got something really exciting like Meta that you could be in instead, right? And for good reason. Those businesses are strong businesses in a lot of ways, right? They're businesses, as I discussed in my Q&A class here today, that can scale much more easily than businesses of prior decades. So there's a reason why the tech stocks are as powerful as they are. It's not just a fluke that they happen to have large market caps. I think in a lot of ways the market caps are somewhat deserved. Maybe the valuations are a bit rich, but I do think that most tech companies do deserve to be some of the biggest companies on planet Earth right now. Their business models are just superior to most other business models out there. So dividend yield out of favor right now, as this is a market that has found itself obsessed with AI and other growth themes here at the moment. All right, let's go ahead and now pop back on over here to the Paper Money platform, and let's get into our first set of 12 grids. This will be chart 5A for those of you that are premium members following along at home. And a reminder that when we're looking at these 12 grids, we don't have those changing colors within the charts the way that we do on the 4 grid. Instead, we just have one color associated with each of these 12 miniature charts, and that one color will tell you what the current posture is. Just the way that it's kind of designed, it would be very difficult for your eyes to make heads or tails out of anything if you saw the green pink switch over and over again on these miniature charts. So anyway, a little bit easier for your eyes perhaps to read it in this way. So as we get started here, let's start with the lower 2 corners as we have for the last couple of years, starting with lower right-hand corner in this case. We've got the 10-year U.S. Treasury yield, and as I mentioned just a moment ago, we've had elevated interest rates here, especially more recently, call it the last 3 weeks or so. You can see we've been trading near 3-month highs in interest rates. Now this is the 10-year specifically, but remember how you read this on the Thinkorswim platform is you do have to move that decimal over on TNX once to the left, and that will tell you that the current 10-year Treasury yield is effectively at 3.79 or 3.8 if you wanted to round up. So that is on the higher end of the scale over the last 3 months. Back here in April, of course, we had prices sell, or interest rates, I should say, sell off to the point where we had these oversold cluster signals, and we had quite the response to those oversold conditions. Now we're up here probably a bit closer to overbought conditions. We're not there, and we haven't seen any of those red dots show up yet, but if they do, we'll be sure to let you know here in these videos. So we had a pretty solid move higher in interest rates today. However, because prior to today, we actually had 4 out of the 5 prior candles red, we still have a weekly bearish posture. But I do get the sense, because we're so close to these recent price ranges, that if we go up again in interest rates tomorrow, let's say we went up another 75 basis points tomorrow, I would think that would be enough where the posture would flip from weekly bearish to probably strongly bullish. Remember, we can right click on these and maximize the charts to see the indicator down below. And yeah, I feel even more comfortable saying that now, because notice the green line is just barely out of the upper reversal zone. I mean, it is just by the slimmest of margins outside of it. It's at 79.46 right now. So even just a little bit of an up push tomorrow in interest rates is likely to push us back to strongly bullish posture on TNX. So I wouldn't read too much into the pink background color in this particular case. We still have a fairly reasonable, strong chart there, rising 30-day moving average and all that good stuff. So keep in mind that when interest rates go up, as they did today, typically bonds sell off, and that is what we experienced across our 3 different bond categories that we have on this 12 grid. Starting with The long-term U.S. Treasuries, it was a pretty ugly day for it, down 1.2%. However, because we've had a pretty decent advance out of TLT recently, we do retain the strongly bullish posture for now, and we're still barely above that moving average. But one more down day tomorrow, and you're likely back below the moving average, and it's a possibility that that background color would change back to pink. So we'll keep our eye on it, but for right now, it's hanging on by a fingernail to that strongly bullish posture. The foreign bond market was down about 0.4% here today. Remember, this is the one that I mentioned to you guys on Tuesday that just felt to me like it was as flat as a board, and there's nothing that's changed my mind in that regard since then. We're still basically within this really tight range on BNDX that we use as our proxy for foreign bonds. So there's not really any directional activity that we're seeing out of BNDX right now. We're awaiting further information. There's been a little bit more activity here on high yield bonds. And you'll notice that high yield bonds really struggled today. And the reason for that may very well be because oil prices did poorly today, right? Oil was down nearly 4% today. As you guys have heard me mention in the past, there is some decent correlation between high yield bonds and oil prices because a lot of the corporations that were forced to raise capital through the junk bond market several years ago were those companies that were on the brink because oil prices were so low. In fact, for a while, they actually went negative. Remember that really oddball event where futures contracts went negative very briefly. But the point is, sometimes you get a little bit of extra push either up or down in the junk bond market based upon what's happening with oil prices. So today was actually the fourth day in a row to the downside for high yield bonds, and we're now back below a falling moving average. So that happened very quickly, right? I always like that gif of Ron Burgundy. That escalated quickly for those of you that are Anchorman fans. Of course, back in the day, I used to live in San Diego, so I feel a little bit more kinship to that particular movie. But anyway, that seemed to escalate quite quickly because just a week ago I was saying, boy, it looks like high yield bonds are looking a little bit stronger here all of a sudden, right? And I was kind of using that as a bit of an example of the bullish conditions that existed in a way to measure risk appetite, and that was more of a bullish feather in the cap. Well, here we are just 4 days later, and you could turn that right back around and say, yikes, watch out. Maybe this is something that is haunting the bulls at the moment with 4 days in a row to the downside and back below the moving average again. It's not like a major meltdown from multiple month perspective or anything like that. It's basically just giving back what had happened the previous week or two. Nonetheless, it happened in a straight line in just 4 days, so it's at least noteworthy to point out. So all three of those bond categories were down a touch today. High yield bonds now back to weekly bearish posture. The other two are hanging on to their bullish postures by a thread. In terms of the other corner now, lower corner, let's talk about the US dollar. We did have a slight tick up in the US dollar today. Remember, when we have dollar strength, typically we have weakness in commodities and foreign stocks in relationship to US stocks, and all of those themes played out the way that you would expect today. Strong day for the US dollar led to weakness in gold, which was down basically 1%, and about a 4% down move in oil. In addition to that, EFA, which tracks the developed foreign stocks, so think Japan, Europe, Australia, etc., had another tough go of things here today, down 0.62% when the S&P 500 was up today, and then EEM was also down 0.35% on a day when U.S. stocks were up. Now, again, there's a nice little asterisk next to U.S. stocks. You could use air quotes there perhaps because the average U.S. stock actually wasn't up today. But the way that the S&P 500 is calculated suggests that they were. Nonetheless, foreign stocks did underperform U.S. stocks here today. This is actually the fourth straight down day for EEM as well. Remember, they were taking off like a shot as well. So both EEM and high yield bonds were more supportive of bullish market conditions a week ago. Today, that's being called into question. Now, with EEM still above its rising moving average, I'm not looking at that as big of a problem as the way I'm looking at junk bonds right now, nonetheless, this has been an aggressive move lower. So you got to be a little bit careful with those more volatile areas out there. It's not a great sign for risk appetite. Generally speaking, you'd like to see emerging markets do better than U.S. stocks because there's more exciting growth stories in those areas traditionally, population growth and all that kind of stuff. Of course, today we heard that Prime Minister Modi from India was meeting with U.S. Representatives and politicians. So those two nations hopefully getting a little cozier. I know Apple probably wants that, as Apple is wondering, what to do about their relationship with China and how most iPhones and other gadgets are still produced over there. India is becoming another interesting manufacturing hub for Apple and other American companies. So hopefully those relationships can get a little bit more entrenched moving forward, just in case we have something, ugly on the horizon between the U.S. and China. We shall see. But both India and China are part of the EEM, so maybe they have offsetting effects within that index there. But anyway, just wanted to point out that those traditional intermarket relationships did seem to hold firm here today, with a rising U.S. dollar leading to weakness in foreign stocks and leading to weakness in commodities. Now notice that gold, by the way, now has yet another oversold cluster signal. In fact, this is the new 3-month low on gold prices. And by the way, some of you that maybe were following along with my trade application example from quite some time ago, I had a stop order on that little gold company. I can't even remember what the name was. It might have been something like Fortitude or something like that. I had never heard of that company before. I just happened to like the chart. Well, that didn't work out as planned, right? As is often the case when you're trading. You have to account for the fact that you're going to be wrong regularly. And that one did stop us out here in that gold move lower here over the past week. So, not only is gold itself struggling, but gold stocks are also following suit to the downside. But maybe, just maybe, that little green dot that shows up there will be an excuse for market participants to give you a little bit of a push higher in the short term, right? The way I think about it is oftentimes the oversold clusters do not lead to legitimate trend reversals. Let me right click and maximize this so you can see it a little bit better. Those of you that are newer to the video might not know what those little green dots represent. Remember, they can have red dots as well. The red dots are what we would refer to as overbought clusters. The green dots are what we would refer to as oversold clusters. In the green dots case, it's associated with that market forecast technical indicator when the blue, the red, and the green lines are all in the lower reversal zone below 20 on the same day. Now, that doesn't necessarily mean that you sell the farm and go all in on that position, but what it oftentimes means is if you've been pressing your bets bearishly to the downside, today could be a day to take off some of that bearishness because there's a decent chance you get a little bit of a pop back higher. Now, just like what happened on this last one, where we had this oversold cluster signal here on May 25th, it led to a 4-day rally out of GLD, but notice it fell short of even attempting to cross the 30-day moving average before it rolled over again. So that's kind of the more typical thing that I assume will happen. Now, I've seen it, of course, plenty of times where there has been legitimate trend changes as well, and if that's the case, even better. But at a minimum, I kind of set my expectations that when we get these types of cluster signals, we get some sort of a short-term pop that oftentimes leads to a failure, and we stay in whatever trend it was in prior to that. So is there a chance we get up here closer to the moving average again on gold? I think there's a decent chance of it. And if I had a bearish trade on gold right now, I'd probably start lightening up on that position and look to reestablish a stronger bearish position on it if we do get that expected bounce here in the coming, let's say, week or two. So be on the lookout for that possibility. But things have gone from bad to worse in the gold market. It started off the year with some promise, but it's quickly failed here. So it just hasn't been a great place to be on the long side, as there's been a lot more interest in chasing tech stocks than there is in fuddy-duddy old gold and commodities. In terms of USO, it was down worse than gold today, and USO is kind of an ETF or an ETN that tracks effectively the price of oil, at least from a directional perspective. So you can trade it a little bit easier even if you don't have a futures account. Like if you wanted to pull up the futures contracts, you can do that on Thinkorswim as well by doing /CL. and that will bring you to the light sweet crude futures contracts. They look pretty much the same. The charts are going to, basically go up and down together, whether you're using USO or CL. But in this case, you will notice that it was enough of a give back here. And the other thing that's a little bit different about futures contracts, notice it's still trading right now, whereas USO is already down. So, USO is already done because it's an ETF. It's done at the end of the stock market. /CL continues to trade because it's a futures contract. So it kind of rolled over to the new day already today. So that can have an impact on the posture setting mechanism as well. So right now, crude oil itself, from a futures contract perspective, has now gone to a weekly bearish posture. And assuming that there's not some sort of a big reversal overnight, if USO follows suit tomorrow in the stock market, then it will likely go to a weekly bearish posture tomorrow as well, as it's below its falling 30-day moving average. We should also point out that Bitcoin continues to impress. Remember, it was 2 days ago, I was like, wow, did you see Bitcoin the last couple of days? Well, it hasn't really stopped. This was Tuesday right here that I'm pointing at. And then here was yesterday where it had another gap up. And then today it basically just held those gains. So Bitcoin just went up like a rocket ship, which does happen from time to time, right? It is a very volatile asset class. It doesn't behave normally the way that like a traditional mega cap, blue chip company might. So today, we didn't really have a continuation of the bullish move, but the fact that it didn't really give much at all back to what had happened in the past week is rather impressive. All of a sudden, you can see where we're at on Bitcoin. The only other time on the chart where it was higher was right back here for about a week during this kind of mid-April time period. So right now we're back above 30,000 on Bitcoin, and you can see that it was such a violent move in just 4 days' time that it basically drugged the 30-day moving average up with it, right? Usually there's more of a gradual transition, but this sucker was just like, come on, we're going for a ride. And Bitcoin all of a sudden finds itself up there at the higher levels over the last 3 months. Let's take a look at sectors now, and let's take a look at chart 5C. And so same thing on these charts. Remember, the background color will tell you what the current intermediate posture is according to the market forecast technical indicator. And as I mentioned here earlier, when I was with you on Tuesday, there were just 2 pink charts. Remember, those 2 were utilities, which had been pink, and then energy had joined it on Tuesday. Well, here we are 2 days later on Thursday. Neither one of them have flipped back to bullish, but 2 additional charts have joined them with weekly bearish postures. And those 2 additional charts are real estate, which is now back below its falling moving average here all of a sudden, kind of, similar type of a chart pattern as what we see with utilities. Those 2 are probably your most interest rate sensitive areas. So when we had a big up day in interest rates like we saw today, no surprise that both of those areas did poorly. And then financials. I talked about earlier in the heat map how, a lot of banks really struggled today. Not down just like 0.5% or something like that. A lot of them were down 3, 4, 5% type of behavior. So not a huge surprise here to see financials down for their 4th straight day and now having that weekly bearish posture. However, unlike the other 3 that have the bearish postures, financials are the only one that remain above their rising 30-day moving average. So maybe it's just a little bit of a give back. Maybe it's going to get back on track with bullishness after a bounce up and off the moving average. We shall see. But right now, there is a little bit more bearishness that's kind of creeping into the market environment compared to what we had seen, let's say, earlier this week or even last week. It's part of the reason I've been doing some more bearish trades here more recently as well. Remember, I did the Disney trade exactly a week ago, which immediately went to max gain the next day, which we are thankful for because that does not happen very often. And then I did the Qualcomm bearish trade on Tuesday, and that stock has been down since then as well. So it kind of feels like we're getting to a point where you have to start questioning those valuations a little bit more of the overall markets. The trends are still reasonable. So we don't want to overdo it. And that's the reason I haven't been like buying puts and things like that, right? I've been doing kind of more cautious types of things that come with maybe higher odds of success. But at some point, if one thing leads to another, you just never know what the catalyst may be in the market to either the upside or the downside. We just don't know. Strange things happen all the time. News events affect global markets. And so what we know is that if we're looking at this market, a week or so ago when all of these charts were green, and today we wake up and 4 out of the 11 sectors are now pink, that tells us there has been deterioration in some of these areas, and we want to at least acknowledge that and recognize that maybe, just maybe, there's a little bit of selling that's starting to enter the system here all of a sudden. In terms of who the worst performing area was in the market today, it was actually real estate. So I figured it might have been energy, but as I look a little closer, it was actually real estate. Real estate was down 1.41%. Energy was down 1.34%. So very close. They were both down approximately the same. But real estate did edge them out just ever so slightly. So again, that was probably as a result of rising interest rates. And in energy's case, it was probably a result of rising dollar, US dollar. In terms of who the best performing sector was today, let's see, I think it was discretionary. Yeah, discretionary was up 1.28%. And again, remember that Amazon, if you include the after hours activity right now, was actually the best performing stock today. If you look at just the closing prices here today, it was the second best performing stock today. So either way, it was a very important player in the market today, and Amazon sector happens to be discretionary. So I think this was kind of your Amazon combined with Tesla effect here today, with discretionary easily outpacing all of the rest of the sectors that are out there. In terms of which charts still look the best from kind of a trending perspective, you're probably still looking at the 3 sectors on top. Technology, communications, and discretionary continue to have that strength. And remember, that's effectively what you want to see out of the market, because that's where you're going to find those magnificent 7 that we had referred to earlier. So deterioration still on a lot of these smaller sectors, especially the defensive ones that are interest rate sensitive, and where we find strength continues to be in those growth-oriented areas up there at the top. All right, let's now get into our trade application example. And so I'm going to come over here to chart 3A, our swing trading chart. This one will require a little bit of an explanation because when I took the trade, the chart looked different. And so that is the downside. Remember last week with that Disney trade, we got awfully lucky because we did the trade while the stock market was open, as I do with all of these. But unbeknownst to me, there was going to be a negative news story affecting Disney in the after-hours session last Thursday when their CFO decided to step down. So that helped our bearish trade in that regard. This was kind of one of those opposite cases. Usually I try to do these trades somewhere within the last half an hour of a day because I don't want to do it too early in the day because there's a greater chance the signals will change. If you're doing the trade in the last half an hour, there's a greater chance the signals will hold. But today was one of those rare examples where that did not benefit me. I did the trade, I don't know, maybe 25 minutes before the closing bell or whatever it was, and what I did was a bearish trade on Starbucks. And unlike what I did with Qualcomm on Tuesday when I used options, this one was more akin to what I did a week ago with Disney, where I'm just shorting the stock outright, just keeping it nice and simple. But as you can see, the stock actually ended up bouncing in the final 20 minutes of the day, and the signal that I had when I shorted it no longer existed just 20 minutes later at the close of the bell. So had I known how this was going to shake out, I probably wouldn't have taken this trade. So sometimes it works the opposite way as well. You'd like to think that it always benefits you, but there are plenty of times where you're better off having been patient to begin with. So anyway, point is, earlier in the session, the stock was trading down here at like closer to $100.50. It did climb an additional 30 or 35 cents in the last 20 minutes. And believe it or not, that 30 or 35 cents was enough to change the posture on this chart. When I placed the trade, and that's another benefit I guess you guys have of looking at the Telegram notes, because remember, here's what our Telegram looked like, and you can actually see my screenshot right there that it was pink at the time when I did the trade. So that's, I guess, another benefit that usually doesn't come up. It's a rare instance here, but at least to prove to you that I'm not just feeding you a bunch of lines or something like that. It did have a bearish posture at the time that I took the trade, but the problem is I just don't know what's going to happen with the stock market in the final 20 minutes, and today happened to be one of those days where we got a little bit of a push into the close, and so my bearish posture, which was the reason I took the trade, went away and actually went to a bullish posture. Remember, on this chart 3A, we're using the near-term line to set our posture because we planned on being swing traders with this trade, right? This was not expected to be a trend trade in this case. If it was a trend trade, I'd use the green line. If it's a swing trade, I like to use the blue line. So when I took the trade, that blue line was still rolling over, but with that last 35-cent push into the close of the session today, it actually brought that blue line up and started plotting that bullish posture. So this one may not work out as well as the Disney one did a week ago. Then again, some of the basics still are associated with the chart. What I kind of liked about this was that you had this similar situation, so similar to what I identified with GLD. Notice you got all of these oversold cluster signals right here. You've got one final one right here, which did lead to a reversion to the mean rally, and then it's really struggled to get up and over that moving average. That downward trending 30-day moving average is acting as resistance with it right now. And so my hope was that it would roll over from this point forward and come down to where our price target would be. This was a 1-for-1 reward risk relationship or ratio, similar to what I did with Disney a week ago. So I'm risking as much as I'm willing to make, or if you want to say it the other way, I'm making potentially as much as I'm willing to risk. So it's kind of a coin flip type of a trade. And my hope is that the trend of Starbucks continues to go to the downside, where we would then lock in our gains by buying it back, the short, back down here where it had traded just a week or two ago. We would not require a further breakdown to multi-month lows. We would just need it to get back to where it was trading here in general a couple of weeks back. So might not work out judging by what I saw at the end of the day today. Nonetheless, the trade is live. We'll see what it shakes out with. Of course, if the trade does either get to a stop loss or get to our target price, I'll let you guys know on Telegram, those of you that are premium members of Market Scholars. Okay, so that's what I had for you here today. Hope you enjoyed the presentation. If you did, I ask one simple request out of you. Take 5 seconds out of your day and click like for me there on Twitter. As long as we're up and over 100 likes, by the time I'm scheduled to do the video again on Tuesday, I'll be more than happy to give you a full-length hour-long version. And again, quick reminder, I'll be gone a week from today. So next Thursday, I will not be doing the video, as I will be on a flight. My son hasn't been on an airplane for many years, well before COVID. So it's going to be interesting to see how he experiences flying here all of a sudden. But I'll be out of state next Thursday, so I won't be doing it then. But I will be here next Tuesday. So whether it's going to be a 15-minute version of the video or whether it's going to be an hour-long one like this will depend upon what you guys say collectively through your likes. So I hope you all have a wonderful weekend as well. I believe David should be back with you tomorrow, and I'll see you all early next week. Take care, everybody. Bye-bye.